welcome Megan and Byron from the Three Pillars Law team. Thank you so much for being with us today, kind of talking a little bit about the real estate syndication law, some of the new regulations, et cetera, some of the trends you're seeing in the syndication space these days. If you guys aren't familiar with Three Pillars Law, they're based down in Castle Rock. I'll let them talk on behalf of their company, but thank you so much for joining us.
Thanks for having us.
Excited to be here. Thank you.
Kevin here from InvestNext, one of the founders here on the team. Pleasure to have both of you on today's kind of meetup here. So looking forward to getting everybody around this and getting some learning around this.
Very cool. It's been fun to get to know you guys and your team over the last few months or so. I can start with just a little bit of background. I'll introduce our firm and give you a little bit of background about kind of how we started getting involved in helping people raise private equity. So as Evan mentioned, we're located in Castle Rock, Colorado. We're about 20 minutes south of Denver, between Denver and Colorado Springs. We occupied this office about 3 years ago. We've been a firm for, I guess, since 2012-ish. Actually started out as a general practice firm. Realized quickly that rather than chase clients and deal with family law and civil litigation and those kind of legal matters that were ripe with conflict, we wanted to pivot into something that was more interesting to us on a personal level. We wanted to deal with people that were excited about building something, people that were motivated, rather than deal with conflict all the time. And so had an opportunity with a local business here to serve as a quasi general counsel, learned a little bit about how they raised money through private equity offerings, through these Reg D exemptions that we're going to talk about. Fell in love with it. We've escalated pretty quickly over the last 5 years. I think at one point we had calculated we had helped maybe about $350 million, $400 million in real estate acquisitions. So our, the context for us in terms of these Reg D exemptions is really in real estate. I would say 99% of our work is in real estate. We've done a couple other funds for other investment opportunities, but real estate is certainly our sweet spot. We've got four full-time staff members here, and then we have a number of counsel attorneys. And so as we need to surge over time, if we end up getting more business than we can handle in-house, we have some really strong relationships with some really impressive attorneys that can help us as we need to scale and grow. On the personal side of the house, I'm a retired Army guy. We really like to focus on the veteran community, veteran entrepreneurs. We've done some volunteer work with a nonprofit called Bunker Labs that focuses on veteran entrepreneurs. We also actively invest. So my wife and I own 2 real estate investment companies. We invest primarily in southwestern Colorado, 100 doors of mixed family, multi-use type properties. And so that's been fun to be able to apply what we do on the legal side of the house, on the personal side of the house. And I think that at the end of the day, it lends nicely to giving good legal advice, but also maybe some business advice to people that are right in the thick of it. So Megan, I'll hand the conch over to you.
Yeah, it's always hard to follow Byron up with his impressive bio and background, but I'll do my best. So I've been with the firm for about a little over 2 years now. When I was in law school, I focused on startup law and securities law, and I interned with a legal tech startup throughout my last year of law school. And then that was my first job out of law school. When I met Byron, I really liked the sort of intersection of securities law and real estate. And before I met Byron, I didn't even know real estate syndications were a thing. So I was really attracted to the idea of helping people invest in tangible things rather than in the startup world. There's a lot of intangibles. So I really liked the sort of the satisfaction of being able to point at something and be like, I helped create that, instead of something intangible. And as often happens in the startup world, things don't work out probably 90% of the time. So I'm also an Army veteran. and I currently serving in the National Guard, Colorado National Guard as a JAG officer as well. So pretty much everybody in our firm, well, I'd say about 70% of our firm is veterans or still serving. And I'll echo what Byron said. We do love serving the veteran community, but I think the best part about my job is my clients. Syndicators are most of the time people who are just trying to get out of their W-2 jobs, and they're starting out as a side hustle. And it's really fun working with people to try to, reach those goals and work with them through 1 or 2 syndications and get them to the point where they can quit their W-2 job and, pursue their dreams of being able to sort of, it's still a lot of work, but sort of live without the restrictions of being chained to a desk. So yeah, that's my background.
Yeah, I think that's what I love most about working with you guys, is you guys have such an amazing background, and making a social impact is such an important piece of business. We can all sit at a desk and work a job every day, but being, that you're veterans and you're supporting other veterans is huge to me. And I love that about you guys.
Yeah, thanks, Evan. And I'll mention too, or else Byron will be mad at me. I'm also a real estate investor as well. I forgot to mention that, which is one of the perks of working with Byron, as I get free mentorship. So I'm not a syndicator myself, but I've got properties in Colorado, Arkansas, Maryland, and Costa Rica as well. So I'm learning, and I get to learn with Byron. And I think that's one of the real benefits of our team, is that Byron is a syndicator, and I'm an investor, and we know some of the pain points that our clients are going through.
Absolutely. Yeah. And I'll second that. I had no idea real estate syndication was a thing either until I started in this business. And it's just exciting to see what people are able to do. And, having you guys have experience with syndications yourselves, as you mentioned, Byron, I think having that, not just legal advice, but mentorship advice and, business advice on top of it, just makes you guys stand apart a lot. So
Thank you for that.
absolutely. And I know you guys have a presentation to get started on. And I know one of the big topics that we're hearing these days, as Brad kind of asked a question earlier about SEC compliance with accreditation, and is it for 90 days? Is it for 5 years? But I know you'll get into that. But why don't we go ahead and just get started, if you want to share that presentation and dive right in.
Great. So Megan's gonna drive today while she's getting that set up. What we did was break this down really into 3 parts. We'll talk about SEC regulations and kind of the typical hot topic issues that syndicators are dealing with. I'm gonna high five. Megan's gonna talk about joint venture deals as opposed to syndications. And then we're gonna shift gears back to talking about a fund-to-fund structure, which is kind of the soup du jour right now in this space. So we'll talk a little bit about how to structure that and some of the potential pitfalls. So
Are you all seeing my screen here?
we are. I think you jumped right to SEC regulations, right? And I think we may want to back up just a touch, Megan, just to talk real briefly about the relevant law.
Sure.
So the reason I want to highlight this is there's not a lot of discussion about these other Securities Acts. So we're going to talk a little bit how to navigate these depending on the type of raise that you're doing, where you're going to deploy your funds, and then how you stay out of the realm of the Investment Advisors Act. And so you'll hear a reference to these. These are really kind of the big 4 that we take a look at. Generally speaking, the Securities Act deals with the exemptions that you're using to actually raise money. So I'm sure people have heard the 506B and 506C when you're talking about those rules and those exemptions where you can raise money without registration. That's the act that we're talking about. And then we'll get a little into the Investment Advisors Act, what is and what isn't giving investment advice. And then the Investment Company Act really deals with, once you raise these monies, how are you going to deploy that capital? And how do you need an exemption from the Investment Company Act if you're dealing with real estate or in this fund of fund structure? So that's why I wanted to kind of highlight these. This presentation will be available after the fact. So in some places where it gets a little bit thick, we'll try to move through that and just highlight the most important part of that discussion. So go ahead, Megan. Thank you. Okay, so the Securities Act, Reg D exemptions, you've heard, I'm sure 506B and Rule 506C. These are the two exemptions that we use, I would say, well, probably 99% of the time. You'd be astounded with how much private equity is actually raised through these two Reg D exemptions. You don't hear a lot about Rule 504, and to be honest with you, it's not really prevalent right now. Because I think most of the things that you're trying to accomplish, you can do so with one of the other Rule 506B or 506C exemptions. And so what we're dealing here with is federal law. And one of the reasons these are both so popular is this federal law exempts most of the state securities laws. There's one small exception. We were talking about blue sky notifications and blue sky filings. And so this is one of the things that the Securities Act has allowed for is, yes, it's federal law and it preempts the state laws, but they've allowed for the states to have notification requirements. And so if you're out there raising money, depending on what state your investors are in and how much money you're raising and whether they're accredited or non-accredited investors, you may have a notification requirement that you have to adhere to. So we may get into that a little bit more later. So Rule 506B, this is really popular, especially for people that are starting out in the syndication space. So we see kind of a natural progression, and Megan will dig into this a little bit deeper in subsequent slides, but natural progression from purchasing an asset on your own. You know, at some point your balance sheet kind of peters out. You go find somebody to partner with who can help sign or guarantee on a loan, who's bringing some capital to the table. You guys are both actively participating in this real estate investment. Then again, at some point, you know, your two balance sheets culminate. This is where we get into private equity, right? And so what we're basically doing here is using other people's money to go out and invest in real estate. And so people that are just starting out, it's fairly common. They're going to do a friends and family kind of round, right? So they're going to take advantage of people that they know. And in some cases, some of those friends and family may not be an accredited investor, and we'll talk about what that standard is. So Rule 506B allows for up to 35 non-accredited investors, but you'll see that we couch that with a certain level of sophistication. And we'll talk about that in a minute here too. One of the constraints here with the 506B offering, no general solicitation. So you can't put together details of a deal and push it out on Facebook, or push it out on LinkedIn, or send it out to some cold email list that you got from some company you purchased list from. Can't send out postcards, right? These are all the kind of things. At the end of the day, the information for your offering can only go to those people with whom you have this pre-existing relationship. We'll talk in a little bit here about what the substantive relationship piece is there. So people generally use this Rule 506B a couple times to take advantage of their current existing network, friends and family. And then at some point, there's kind of a natural progression into a Rule 506C offering. And so people will generally use 506C when they need to do a larger raise. They need to get outside of their network, right? They want to expand their horizons to other prospective investors. And so the advantage of using this 506C offering is you can get out there and openly solicit. And this is probably what you see, and you're getting on Facebook or LinkedIn, or you're getting text messages. It's very common to get emails. So if you get on somebody's website to download their ebook, right, that's what they're trying to do, is get your email address so they can start shooting you offerings, which is perfectly permissible under this Rule 506C. I'm not going to elaborate too much on Rule 504. So let's go to the next slide, Megan. Let's talk about, individual accredited investors, right? So This is what you're looking for 99% of the time when you're first starting out and you're doing your first handful of raises. So you look at the friends and family round, and you may have people that don't meet this standard here. So what is an accredited investor? It's a net worth of $1 million, but you have to exclude the equity that you have in your primary residence. So that's an important note. And then a natural person. So it's or somebody with a $200,000 in compensation, whether it be W-2 or you're self-employed, whatever it may be, $200,000 in compensation each of the last 2 years, $300,000 if it's joint income with a spouse. So if you can prove it either through tax returns or whatever it may be that you've made that money over the last 2 years, and you have a reasonable expectation of the same income level in the coming year, right, or the current year. And so, where are circumstances where that may not be the case? Well, the obvious answer there is divorce, right? Somebody goes through divorce and loses half their net worth, right? Or somebody gets terminated from a job. So you got pretty common, a lot of people that work in, as a high income W-2 earner, let's say the tech industry, right? The tech industry is notorious where people start to earn great compensation on the W-2 side of the house, but every time there's some new company stands up or there's some sort of merger or acquisition, potentially you have people being laid off, they lose their job. And so you have to take a look at that reasonable expectation of the same income level in the current and coming years. One of the ways that you can kind of piggyback on this accreditation standard here is if you are a non-accredited investor, but you stand up an offering to sell securities to purchase a piece of real estate, and you're a director, executive officer, or GP of the company selling the security. So this is pretty common, where you'll have a great opportunity out there, and somebody who may not be an accredited investor otherwise serves as a principal on that team, that company that's making the offering. Then you can basically piggyback into that deal as an accredited investor. And then on the private fund side of the house, so knowledgeable employees of the fund. Again, there's no bright line rule here, but at the end of the day, from a public policy perspective, all of these rules are really designed to make sure that we're not taking advantage of people that are non-accredited investors and people who, if they make an investment and lose their money, right, then we're not foreclosing on their house. They're not filing bankruptcy because of this investment. We're also protecting investors by making sure that they are informed enough to actually make a good investment decision. And we'll talk about that more in a second here. Go ahead, Megan. So we have some other entity level accredited investors. I don't want to get into this too much because, again, these are the type of investors that you kind of grow into, right? So your initial handful of offerings, you're looking for what's commonly referred to as retail investors. That's the individual investors that I was talking about before. At some point, once you've developed a track record, once you have so many assets under management, once you've gone full cycle on so many deals, and you become competitive in the market space as a sponsor or an operator, then you have the opportunity to take a look at some of these entity level investors here. And so we're talking about family offices, we're talking about insurance companies, right? Pension plans. Those are the kind of things that we're talking about here. And so again, you can review this at your leisure if you have access to the slide deck later. I don't want to spend too much more time on this. Next, please. Okay, so we talked about this briefly. No general solicitation with the 506B. I want to talk about pre-existing and substantive relationship. So high level, there's a question about what's going on in the securities world right now. Well, the SEC just relaxed that accredited investor definition, right? But inevitably what you have is people are going to try to figure out how to circumvent some of these other constraints. How do I get around this limit of 35 non-accredited investors? How do I do that, right? Because that's kind of the low-hanging fruit, my friends and family who may not meet that accreditation standard otherwise. One of the things that I think they're going to take a good hard look at is, what is this pre-existing and substantive relationship? And so pre-existing matters in relation to the word offering, and we'll talk about that on this next slide. But at the end of the day, this is kind of one of the few bright line rules that comes out of these Reg D exemptions. The pre-existing is there's a line in the sand. Either you know this person beforehand or you did not. If your initial contact with this person is after you've made an offering, a pre-existing relationship does not exist. So we see this a lot of times. I see it in the various mastermind groups that I'm in, or, we get these questions a lot is, hey, I've got this 506B offering that's out there for a 200 unit apartment complex in San Antonio. How do I go find out? How do I find additional investors? I was like, well, it's a 506B and you just put some deal details out there into the world, right? So your offer is out there. It's a little bit too late to establish this pre-existing relationship. Something else to consider here is you'll hear some opinions that there's some sort of cooling off period requirement from the time you make initial contact with someone to the time you've developed a pre-existing relationship and then can make an offering. And to me, it's kind of a balance with this substantive relationship. And here's an example I'll give you. You may have met somebody very briefly on a phone call or in a mastermind group 2 months ago and had a 2-minute discussion about their investment objectives, what they're all about, what you're all about. And that's it, right? And then 2 months later, you've got an offering and you're assuming that I have this pre-existing relationship. I'm gonna go ahead and shoot this offering out to this individual. But at the end of the day, you may not meet that substantive relationship requirement. On the other hand, you may go to the Best Ever conference and you meet somebody on the little What's Up app. You're texting messages back and forth. Hey, I can't wait to see you. You have coffee day one. You have happy hour day one. You have lunch on day two, and you have breakfast on Sunday. And now you've spent a cumulative 3 hours with this person where you can tell them about you and your experience. You can learn about them and their ability to understand kind of an offering and what that looks like. And you can then determine that they can make an informed decision regarding the investment, right? So to me, even though you've only known that person 3 days, the fact that you have that substantive relationship is much better than a 2-month window where you talked on the phone for 2 minutes. So let's go to the next slide, Megan. So what is an offer, right? And this is where there's some confusion is people think that they're only making an offer when they've pulled together a PPM and they've pulled together an op agreement, a subscription agreement, and they've got all their documents finalized and they're doing a webinar and they're kicking out an offering memorandum. At the end of the day, if you're engaging in these activities here, attempting or offer to dispose of, solicitation of an offer to buy, at the end of the day, if you're providing deal details, if you're talking about anticipated returns, and how hot this deal is going to be, that to me is the line in the sand where you've made an offer. And so trying to establish a pre-existing relationship after the fact, I think there's some exposure there. So that's our position on that. That's how we advise our clients. So I hope that's helpful. I kind of dug into this with the example of the vignette that I gave you. So I'm not going to elaborate here, but you can see you just have to make kind of a reasonable determination if you've met these two requirements here. Let's go next, Megan. Great. Okay, so I want to talk about the sophistication factor. So this 506B offering allows you to use non-accredited investors, but that's not dispositive, right? What we need to do as the sponsor of a deal is take a look at the person's level of sophistication. And again, not a bright line rule, but we're looking on a factor by factor analysis of how sophisticated the person is to make a decision. So we look at education, occupation, investment experience. But let me give you 2 examples. If you have somebody who has a high school education, but left high school, started working in the trades industry, and ultimately gets promoted to some sort of construction management position, and has seen real estate deals go full cycle, is that person sophisticated enough to understand a real estate deal? So I would say yes. On the other hand, you may have somebody who's highly educated, and this is a very popular target market for syndicators to find accredited investors. But suppose you have somebody who has, is highly educated. They've got a master's degree in this or that, right? Let's say it's music. They've got a master's degree in music. They make decent money, but they don't quite rise to the level of an accredited investor. they have limited to no investment experience. To me, that person wouldn't be sophisticated enough to understand the details of a deal. And so what you're seeing a lot of times is sponsors who are trying to get into this industry, they'll start up some sort of education platform. And so they'll routinely educate, you know, these people in their network on here's what syndication is all about. Here's what multifamily is about, or, you know, here's what private equity is all about. And through that, they're kind of accomplishing two things, right? They're establishing a pre-existing relationship because they've got multiple interactions with that person. And then they can verify, well, hey, you know, this person has been through my 6 modules of education on how to get wealthy in real estate. So just something to consider for you guys that are just out there getting started out. This has been a very, very successful way to develop that 506B investor network. Go ahead next, Megan. So we've got the pros and cons of each. I think we highlighted this. One is obviously the pre-existing relationship, and then the ability to openly solicit. So 506B, you can't send it out on Facebook. 506C, you can. Let's go next.
I think that's the end of your presentation.
Okay, I'm going to give you relief then.
Okay. I'm going to talk a little bit about joint ventures versus syndications. Might jump around in my slides a little bit. The term joint venture gets used to mean a lot of different things. So I'm going to skip forward to this slide. So this is kind of like the evolution of a syndicator, right? Like Byron mentioned at the beginning. So you might start out investing in a single family home, a few townhomes, maybe some short-term rentals. Then you move into small multifamily homes. You buy a duplex, a quadplex, maybe you bring in a partner. As Byron mentioned, you know, once you kind of max out your balance sheet and don't have the money to keep investing your own money on that 25% down payment, maybe you're going to start to look at syndicating. And the first step for a lot of people is investing as an LP in someone else's syndication. And then I'd say the last step is, you know, putting together your own deal. So there's a couple different ways where joint ventures come into play here. And so the first one I'll talk about, and I'm totally out of order on my own slides, but is going to be happening kind of in the beginning stages when you're investing your own money. And why is this important? Because you don't want to inadvertently be selling securities. So anytime you're taking people's money and they're just giving it to you and you're doing all of the work and then you're giving them money back and they're not having any participation, that's the definition of a security. So one way where that might play out is, so you've got a property. I'm MSM Capital there on the left. So I've got two friends. One friend owns the property, one friend has capital. So the friend with the property is going to contribute his property into the LLC. And then the other friend is going to contribute capital to pay for the rehabs, the construction, anything like that. I'm going to be doing all the work. And then these two aren't going to do anything further. So what is that? That's a security. Because they're not participating, all they're doing is contributing assets or money. And then I'm doing all of the activities to provide the returns. This is a security. So how do we get around this? Just make sure that you've drafted into your property LLC operating agreement that the other two individuals have voting power to either remove the other member as the managing member, or selecting the GC, the property manager, a liquidation of the property, anything like that. And then these two entities or individuals will be considered actively participating and you don't have a security. So this is sort of the first context of when people use the term joint venture. And I'm going to skip back. I think the other context where it comes up a lot, and then back to this slide. So now we're talking about syndicating your own deal. So when you syndicate your own deal, you're going to act as the GP or the sponsor, and then you're going to take in LPs to provide the capital to buy the property and do the renovations. So there's two different types of management structures here, co-GPs versus a single management entity. And what that looks like on the left here, you're going to have co-GP1, which is you, and then co-GP2, which is your partner. rather than forming a distinct management LLC like you have on the right. Say this is a new partnership, you've never worked together, you're not quite ready to form an LLC and really formalize the relationship. You're just going to work together in a joint venture, but not in a formalized entity. So you'll just have a JV agreement, which is just contractual between the two of you to manage the SPV, which is the syndication. And then conversely on the right, maybe this is step 2, you've worked together, you agree you work well together, you're going to form an LLC, and then you just have the operating agreement that governs the terms of that relationship. This is just a little bit on GP roles and responsibilities. So if you do have the co-GP relationship, you want to make sure that the co-GPs are actively participating in some part of these GP roles and responsibilities. These are just a few examples: capital raising, asset management, deal sourcing. You could have multiple GPs, you could have 2 that split these duties up, but everyone needs to be actively participating. And just threw this slide in here, but we already talked about this. This is just explaining if it's if they're not actively participating, it's a security. Sorry, went a little out of order there. And then the last topic we're going to talk about is funds of funds. Unless anybody wants to jump in with a question, we can just answer questions at the end. Anyone from InvestNext? Sorry, I kind of blew through that.
Hey, Megan, I'd like to, Cordy's got a good question here that's relevant. Best practices for setting up GP LP structure and how to handle losses and taxes for GPs and LPs. I want to answer the first question. You'll see, so one, the practical purpose of kind of testing the waters with a co-GP on the joint venture side of the house is, rather than jump into an LLC structure right away with somebody that you haven't done multiple deals with, what you're basically doing now is you're obligating yourself to the terms and conditions of a full up operating agreement. So you're going to have to, I mean, you're talking about a 40-page contractual agreement that may be unnecessary for the first time out that you're working with somebody, right? And then you have to maintain this LLC. So you have to maintain this entity over time, which is, there's filing fees that go into it. There's a full-on operating agreement, so it's more expensive to set up. And then you have to maintain this thing year after year until you dissolve it for one reason or another. And so from an administrative standpoint, it's a real pain. So we advise our clients that are coming together on these co-GP structures where, and where this makes sense is, you know, on the syndication side of the house, you're looking at a handful of responsibilities that go into an operator or a syndicator, right? So a fully mature, developed team, some of the bigger operators that you'll see, they have a CEO type, they've got investor relations, they've got marketing, they've got operations, and then they got a finance type, right? So let's just say those are kind of the 5 big roles and responsibilities. Well, you know, first time or junior syndicators, you don't have a full team like that every time. And so you may be serving 3 of those roles, and you go find somebody that's going to serve the other 2 roles. And you're going to try each other on for size. It's like a date, right? It's a dance, it's a courtship. So rather than codify all of this in a management entity or an op agreement, why don't you go on a date first, right? That's important. And then who makes a good co-GP? It is. It's somebody who's filling a role that you can't fill. So, you know, if you're the CEO type, if you're the visionary, you don't need 4 visionaries. You need an implementer, right? So you need a visionary, you need an implementer, and you guys divvy up the rest of the tasks together. But ideally, somebody's coming to the table with some sort of attribute that you don't have. That's when these co-GP structures make sense. On losses and taxes for GPs and LPs, you know, there's a couple different ways to craft that, and I'm going to give you a typical legal answer. It all depends on the facts of the deal, right? You're going to have deals that are development deals, and so you're going to have nothing but losses for the first 3 or 4 years. And you may have a huge capital provider that comes in and says, hey, I want to take all of those losses in exchange for the capital that I'm going to bring to the table. And that's what the LLC structure allows for, is what they call non-pro rata distributions and allocations of tax losses and whatnot. But it's an important note. And you definitely want to address that if you're structuring a deal. There's just 1,000 ways that you can do that. right? And then there's 1,000 ways that you can structure waterfalls and distributions and, different, we call them levers in our office. So when you're structuring a deal on the GP side of the house, at the end of the day, you got to figure out how you're going to incentivize the type of investors that you want by pulling what levers are going to incentivize them to put in the types of cash that you want. So like a development deal, that's a 4 or 5 year deal. It's going to take a while. Raw dirt to development, you're not going to start seeing returns until year 3, 4, 5, and then you sell and there's some huge upside. Who's a good investor for that? Maybe it's somebody with a self-directed IRA, right? It's not somebody who's living paycheck to paycheck and is going to be relying on their return from that 50K investment to pay the bills. And so you would structure your deal a certain way to incentivize those types of investors to come in. And that's, at the end of the day, that's what you get, I think, when you have good counsel. And then the beautiful thing is on the InvestNext side of the house, these guys are able to wicker in all of those different levers into your deal and help you track and optimize that investment. It's really impressive what you guys have going on. Yeah, so let's go on, Megan, to the fund of fund structure. All right, so this is kind of the soup du jour right now, as people are talking about fund of funds or feeder funds. And where this is really coming into play, I think, is kind of 2 ways. You've got somebody who's been an operator or a sponsor. When I say operator, I'm talking about somebody who's actually buying a property. They're managing the project, the renovation, and they're doing the lease up and stabilization. They're doing all that work, right? And over time, they develop this huge investor pool. But there are occasions where deal flow is tight and they want to keep these investors satisfied. And so what they may do is cobble together their investor network and pull together an offering to invest in somebody else's offering. They're not going to maybe they're not going to operate that apartment complex or that self-storage facility, but they're going to do some form of capital raising and participate in somebody else's deal. That's pretty common. The other thing that's happening right now is people are starting to systematize getting investors, right? So you have people that are out there that have coaching programs and mentoring programs that teach about they don't teach about how to operate an apartment complex. They may not even teach how to underwrite a deal, but they're going to teach about how do you do marketing? How do you find investors? How do you develop an investor network without having a track record of operating a facility? And it's happening right now. And it's this really interesting generational thing, because you have old timers who have done construction management and have operated projects soup to nuts, but they're scared of using technology. And then you have these youngsters who don't know how to use a hammer, but by God, they can build an active campaign, right? And so what you're getting now is the old timers still need money to do development deals, and the youngsters are out there able to generate cash in the form of capital raises. And so it's a really interesting time right now where we are. But with that brings another host of issues, right? So now we're getting into the realm of this 40s Act. So we talked about Securities Act 1933 is what rules or what exemptions do you use to raise money? But then the second and third part of that analysis, the second part of the analysis is, okay, where are you placing that capital? So what on this diagram here shows is somebody who's setting up a fund, they're issuing securities. So that SPV is a special purpose vehicle. It's an LLC or limited partnership formed solely for the purpose of selling interests to raise capital from LPs to then turn around and invest in other securities, right? So when we're selling securities and then we're investing in securities, now we've got to navigate this Investment Company Act. And so we've got to go find a couple of exemptions there as well. The most common are 3C1, 3C7. And each has its kind of limitations, similar to the 506B and the 506C offerings. You have limitations with those as well. And then the second piece is when you are investing in securities, you may or may not be giving investment advice. And we can kind of talk about how that plays out. But How I like to explain this to our clients in terms of the investment advice is really on a continuum. And what I mean by that is everyone's familiar with like a blind fund or a hedge fund where you put money in, you invest, but then the sponsor of that deal or the fund manager has absolute discretion on where your money goes. So they may go invest in stocks, bonds, mutual funds, CDs, promissory notes, they may go find some alternative investments and this and that. But when that's the case, you as the investor are reliant really on the discretion and the advice of that sponsor, that fund manager. On the other side of the house, if you do a fund to fund into somebody else's offering and it's one offering, right? It's some self-storage fund. And it's very specific as to who the sponsor is, what their track record is, what type of facilities they invest in, what geographical area. They've gone this many deals full cycle. You kind of get the drift, right? We're building an avatar of exactly where your capital is going to be deployed, even though you're using this fund to fund structure. So what we're effectively doing is removing discretion from that SPV sponsor as to where your capital goes. And so now the discretion is back in the hands of you, the retail investor. Do I want to put my 50K, which I know 45 of it's going to go right into this other fund? I can review the fund details. I can look at the parent offering documents, right? This is where those fund to fund structures come in. The other piece that's important on this fund to fund structure is, in my personal opinion, when it really works is if you have a parent offering out there, so let's use a self-storage fund as an example, and there are different economics in the types of units that are being offered. So they'll structure that up in a way where it's, okay, the 50K retail investor comes in and they're going to get a 7% pref, right? $1 million investor comes in, they're going to get an 8% pref. And then a $2 million investor comes in, they're going to get a 10% pref. At the end of the day, you can set up this fund to fund structure because there's enough spread in there where if you hit that $2 million mark, you form your little entity and you go find, 40 investors at 50 grand a pop. I think that's 2 million, right? And your entity is going to get the most advantageous economics from that parent offering. And then you as the sponsor, of course, you can take out, whatever, some administrative fee, you take some bit of the preferred return, you take some sort of haircut off the top. At the end of the day, you're incentivized to cobble money together. And I think you can feel ethically good about it because you are offering your retail investors better economics than if they went straight to that parent offering, because they'd only get 7% anyway. So you construct your offering in a way where you bring your 50K guys in and say, I'm going to give you 8.5% pref. Then I'm going to get, 1.5 or whatever it may be. And then we'll split up the remainder a certain way. And then, oh, by the way, you're going to help me with the expenses that I incur with setting up the offering and running the fund. And so this is where at every opportunity we talk about how much meat is on the bone for a sponsor, right? If there's not that stratification of classes, there may not be enough meat on the bone where you can justify putting a fund together to invest in somebody else's deal. What I may do here is just take a brief pause if we have a question about this, because we get this a lot and it can be a little bit confusing. I didn't see anything on the questions in the Google document, but if anybody wants to ask a question about this, this may be a good opportunity. Okay, we'll save it for the breakout, maybe.
Yeah, if nobody has any questions, I'm just curious, like, what is the incentive for a syndicator to take in funds from this fund and have to pay out additional, returns on the GP side, right? Most people that invest from a fund to funds into my deal, are we, then offering a portion of the GP, and it's just part of, not having to deal with all the capital raising? Is that why people are taking in money from the fund to funds?
That may be the case, but you know, what you're talking about really is like somebody who's setting up like a, you know, 10, 20, $30 million fund, right? And those are the people that are creating those stratification of issues or of interests, right? Because if you got a little $5 million fund or $5 million offering, you may not have to incentivize people by coming in at more than 50K a pop, right? If you can do that on your own. But you're talking 10, $20 million. Now it's significant when people are coming in $2 million at a time. And so what's the incentive for, you may have somebody who has the ability, let's say it's a $50 million fund and they have the ability to come take in 25 million. That person, you know, they can probably negotiate some sort of GP or co-GP interest. What you're seeing in this structure here is somebody who doesn't quite have the schlitz to pull off enough capital raising to be considered for a co-GP interest. But it is something that they can offer their investors to kind of whet their appetite while they're waiting for deal flow to come through otherwise.
Yeah, and I'll just add to that too. So I think another incentive to the GP and the parent offering is that they don't have to give up any percentage of the GP. So there's kind of the two ways that you can legally raise capital. Well, three, you can either be a registered broker dealer, you can be a part of the GP, or you can come in as a fund of fund. So I think it's a good way too for sponsors to be able to sort of maybe try someone out that they would like to co-GP on a future deal, to see, you know, how much money they're able to raise. But nothing comes out of the GP's pocket in the fund of fund structure, because the fund of fund comes in as a single investor and they're just getting distributions from the parent offering as a member. So the GP's not paying out any fees. They're not giving up any percentage of their carried interest or anything like that. And then, you know, the incentive for the, well, conversely, if they brought them in as a GP, then, you know, their 30% carried interest is now maybe only 20% or 15%. They're going to have to share the fees. So I think this is a great structure for people to sort of test the waters on potential future co-GP relationships, but also it's an easy way for the parent offering to be able to bring in big chunks of money. It's less investors that they have to manage, fewer K1s that have to go out, fewer people on the investor portal. And so the fund of funds can just bring in large chunks of money for them.
Yeah, that's a great point. And so what we see is occasionally there's a fund that's been published, right? There's an opportunity out there that's been published, and somebody may react to that and set up one of these fund of fund structures. But if they go full cycle a few times and demonstrate the ability, hey, I can raise 2 to 5 million, drop of a hat. Well, now they can get on the front end of a prospective offering and negotiate better terms, whether it's a better class of interest for their guys, whether it's a co-GP interest. But once you have that ability to raise capital, you know, I think you're in different waters there. David, we see your hand, buddy. Have at it.
Well, first of all, can you go back to the other fund to fund slide where there are multiple offerings, target offerings? There we go. My question is, you mentioned that the main fund is issuing securities to the LPs. Okay, but then investing in other people's funds or projects. And if I understand it correctly, if the main fund, the central fund, has complete investment control, then they're an investment advisor to the LPs. But my question has to do with the target fund or the target investments. Do they have to go through their own securities, their own securities offering, or can it be a particular project and the main fund is actually handling the entire securities element to it? In other words, does it have to be a fund, or could it be an investment project which the the central fund is actually linking up the LPs to an investment project.
Yeah, so I'm going to go back to kind of the beginning of the discussion, right? Is the first act that we have to navigate is the Securities Act. And so 99% of the time of, what we see here is these two top funds that we're talking about, in which we're investing money into from our fund of fund. Those guys have to adhere to the securities laws as well. So that's typically a 506c offering that these guys are putting out. And right. And then our fund SPV is then also a 506c offering.
Okay, is there any is there anything where the fund SPV can invest in specific properties or offerings? It's sort of itself, so it's not doing the fund to fund, or is that just the way things regularly happen?
There's a perfect segue. Megan, if you could jump, let's go past the investment advisor stuff to the real estate funds. And I think this is what you're getting at, David, is this is very common. So the self-storage fund I mentioned earlier, right, by way of example, the self-storage fund sets up an offering, 506c offering, and they're raising money from LPs. But rather than invest in securities, they're investing in a piece of real estate. This is not considered a security. Investment in a piece of real estate is not a security. So unlike that fund of fund structure where you're raising money in the way of issuing a security to LPs and then purchasing a security interest, here you're not.
Okay.
Does that make sense?
That's exactly what I'm asking.
Yeah, I figured that's where you were going. So Megan, let's go back to the Investment Advisors Act slide. And we'll just spend a second of this and then we'll get into Q&A. I think we're about time to get into Q&A. So when we get into the Investment Advisors Act, this is what we're looking at, right? So as a sponsor, are you being compensated? Yeah, you're being compensated. You're going to be compensated in the form of carried interest. You're going to be compensated in the form of a sponsor fee, an acquisition fee. You've got this whole list of a la carte fees that you can choose from depending on, the type of project that you have. But at the end of the day, yeah, you're going to be paid. Are you holding out as an investment advisor? Typically not. Are you receiving compensation for investment advice? Well, we're not giving investment advice, and that's what we're going to get to here. So I think, there's lots of discussion right now on this particular topic, whether it be inside our office or with other firms or just in the industry generally. But where we think that we get away from being considered an investment advisor is the providing advice, right? And so this is particularly important when we talk about the fund of fund structure, as opposed to the one we just discussed where you invest in real estate. That's excluded. Investing in real estate, don't even worry about it. But a fund of fund where you're selling securities and buying securities, what we've got to do is go back to that continuum that I described earlier, where you want to stay in the realm where the sponsor has little to no discretion as to where capital is deployed when purchasing an interest in another fund. So it becomes very, very clear. It's either we've already identified the other offering, or we've identified a sponsor that has the characteristics and attributes that we want to model in our fund, right? So we get really, really specific. So if I want to start a self-storage fund of funds or feeder fund, I'm either going to identify a sponsor who already has something that's going on, and I'm going to share all of those details with my investors, and then I'm going to show them here, this is why we're going to cobble our money together, is we're going to get the economics at the $2 million level, right? Or I'm going to say this sponsor with this track record in this asset class, purchasing assets in this geographical area that meet these characteristics. See, we get very, very prescriptive about where those monies are going to be. And so that, in my opinion, keeps us out of the realm of giving investment advice because the investor gets to say yes or no. So I think we hit the high points that we wanted to hit. Megan, if we could just go to the slide, I want to introduce one of our other team members. She's not with us, but if you end up working with us, you'll end up meeting Stacy Bauer. She's one of our counsel attorneys, probably the most active one right now. She's actually teaches the securities course, Raising Private Equity at University of Denver. So she's a professor of law, but she's very active right now in practicing with us as well. So she's done a number of offerings with us, and you just may encounter her at another time. So I think we're on track, right, to segue.
Yeah.
Evan,
Oh,
you're muted.
Evan, you're muted.
Sorry, guys. My dogs were barking. Yeah, I don't see any questions in the chat. If anybody has any, please feel free to type them in there. If not, we can dive into some of these other questions. It sounds like some of them you may have already answered, but one that stands out to me is regarding raising a fund into an LLC as like friends and family. So if you all pool money together, form an LLC, can you invest in a partner's? Can you invest as a partner in the project's LLC without having it to be a syndication for non-accredited investors? Like, could they set up a JV deal between the Friends and Family Fund and the project's LLC? And I don't see Andrea on here, so it was her question, but.
So it sounds to me like they're kind of talking about two different things. But I mean, if you're, so syndication A is a 506B, accepting, or 506C, I suppose, accepting accredited investors only. And they want to create an entity to come in at the GP level, it sounds like.
Yeah, it's kind of interesting. I can't really tell. I wish Andrea was on the call, so maybe we can skip that one and try to follow up with her to see what exactly she meant by that. Because it sounds like me like she's trying to pool money into a fund as an LLC without, kind of skipping over the whole SEC regulations, which I don't know. I don't know the answer to that question.
I mean, I think my answer would be, yes, you could do that. You could come in, you could form a Friends and Family LLC and come in as a GP with the syndicator. In theory, it's possible, but you have to ask the question, what's in it for the GP who's allowing them to come in as a co-GP? Because typically co-GPs come in because, as Byron mentioned, they're fulfilling a role. Or they're going to bring an investor network with them who's going to bring in a lot of capital. So I would say this could work in the context of a smaller deal, where maybe maybe it's a 506C, but it's only for, $1 million. And this group of non-accredited investors wanted to come in as a GP to bring in maybe $100,000. I just think it's an unlikely scenario. Byron, thoughts?
Yep, it's just tough to answer, but I think you address that about as well as you can. Evan, can I answer the second question here? Best qualifying and approval format for potential sophisticated investors. And so the way that you do this in the B offering is there's a very simple questionnaire. So in 506B, and this is one of the benefits of the 506B, is the investor can do their own accreditation, right? I think I glossed over that, didn't I, Megan? That's 2 demerits for Byron. So on the self-accredited questionnaire, it's a threshold question. Are you an accredited investor? Yes or no? And it'll ask all those same questions, right? If you're not, there's another series of questions that flesh out that person's level of sophistication. And it goes to the education, the experience in investing, this and that. What I recommend to do, and this is what I've done with my own deals, is I take that and I turn that into either a Google form or a Microsoft Office 365 form, or I'm sure you guys will have something better than this probably by the end of the day. but I have them go in and fill out that form, right? That way I'm not doing data entry for one. I add in a field that says, who do you know, what principal on this team that's making the offering do you know, and how long have you known them? Right? So now they're filling in the data as to when we met and how long we've known each other. I ask them what their investment objectives are. That way I can see if they know what they're talking about. What asset classes do they like to invest in? Are they investing for immediate returns, or is it a longer term play? So I ask all of those questions. I make them fill it out. They submit, there's a date timestamp. Now I've got something that I can export to Excel and just review. So as deals come across my desk, I do a little sort by asset class. Oh, RV parks, sweet. That, right? So just something to consider. You can, that's something that's probably very, very easy to automate, especially if you're first starting out.
I can answer the question that was posted in the chat about accredited, how long accredited investor status lasts for. So the rules on this just recently changed. It used to be that so on a 506c, you actually, every investor has to have a third-party verification, as opposed to what Byron just explained on 506b, where it's everybody self-certifies to their status. So on 506c, you want to go through the same process where you send them that investor questionnaire and they certify, yes, I am an accredited investor. But before they actually wire funds and sign the subscription agreement, you need to get a third-party verification, which is usually done by an accountant who reviews their tax records, or an attorney, and just verifies, yes, I reviewed this, and yes, they meet the definition. So it used to be that those third-party verifications were good for only 90 days. And the SEC relaxed that with a specific intent, so that to try to make it easier for people to go through this process. So if you've done an offering and you had an investor come in and they provided that third-party verification, and then you do another offering or a follow-on raise to that offering, that investor verification is good for 5 years now. So long as you don't have any reasonable belief that something's changed, like a divorce or a bankruptcy, or they lost their job, as long as you have a reasonable belief that the status is still the same, then you can use that third-party investor verification for 5 years.
I have a follow-up on that because that was my question, but so don't they have to put in writing on subsequent deals that they are still accredited, or if they're filling out the questionnaire saying that they're still accredited, does that validate that portion of it? Or do they not even need to do anything if they're with the same sponsor?
No, technically they wouldn't need to. I would tell a sponsor to have them fill out that questionnaire anyways. Although that's not what's required in a 506c, it's the third-party verification. But so long as you have the relationship with them as the sponsor and you're doing a new offering now, you can rely on that third-party verification for 5 years.
Perfect. Then I had another question that was kind of like the LLC question that I think Andrea asked or whatever. If I'm investing through an LLC, but I don't want do I have to have the LLC qualify, or if all of the members were accredited investors of the LLC, would that justify the LLC? So let's say me and Evan are accredited investors, we're investing through an LLC we have together. Could we come in as through the LLC, but get accredited as an individual?
Yeah, so there's two parts to that. So one of the entity accreditation definitions is an entity, all of the members of which are accredited investors. So you would have to have your third-party verifications for each of you as individuals to prove that the entity is accredited under that definition. Does that make sense?
Yep.
Yeah, so what I advise, if there's a sponsor who's taking money from an entity, at a minimum, I want an accreditation for the entity, right? But then if you're doing an offering like in the fund of fund structure, you would certainly want to have accreditation verification for everybody in your fund who's participating. But what I'll do is I'll routinely write a verification letter at the entity level, especially if it's a small number of people and all I have to do is review a few documents. It's a simple memo.
Cool.
Thank you, Matthew, for your comments. Appreciate the compliment.
Thank you.
And did you guys want to break out, or should we address that last question?
So it looks like Andrea has joined us, so maybe we can answer that question a little better. If you can clarify, Andrea, are you still with us? I do see you're on mute, so maybe you're not at your desk, but we were trying to answer your question regarding the friends and family. Okay, perfect.
Sorry.
So right before you joined, we were talking about your question regarding the friends and family fund investing in a project as a partner. So just wanted to, I think we might have some follow-up questions regarding that. How are you raising that capital for your friends and family fund? And the team here might have some more questions on how to answer that one.
Sure. I mean, I guess it was just kind of a concept of like, you know, for our friends and family that are not accredited and they don't want to put, you know, they can't put, or they don't want to put, you know, $50,000 into a deal, but they could put 5,000 into a fund. You know, could we put together $1 million fund with, I mean, I know that's a lot, but like with little investments, you know, sounds like a nightmare, but could we do that and have them invest as a partner? Like, so that fund would be an LLC, and then that would invest as a partner with us as like a joint venture. So that fund would be bringing, you know, pretty much all of the capital to the project.
Yeah, so I mean, I think that is kind of the scenario that I was describing. So, and my answer was that, yes, it's possible in theory, but the question is, you know, what is the main fund sponsor? What is their motivation for entering into that sort of JV or co-GP arrangement with your LLC that's maybe only going to be bringing in a small amount of money? But if it's a scenario where, for instance, it's someone that you know that's raising kind of a small syndication and they're willing to bring you on as a co-GP with this entity that's perhaps bringing in $100,000, but in sort of smaller increments, then that's definitely a doable scenario. I'd say that we haven't ever seen anything quite like that, but doesn't mean it can't happen.
So it does still have to be set up as a syndication. It can't be like if it's my project, but I also set up a fund that is for, you know, people who can't afford typically to invest big sums of money in these passive, you know, syndications.
I think you're practically going to run into challenges with the 35 non-accredited investor limit, right? So if you're doing that at $5,000 a pop, I mean, maybe you raise a couple $100,000. That may make sense where, you know, you potentially could do that in your own little offering. And then go joint venture with somebody who just happens to need, you know, the $200,000 that you have, you know, that may make sense. And now you're in a joint venture with them.
Sure.
Right? So, yeah, I mean, I think in that kind of scenario, that would make sense.
But it can't be a joint venture. Like it has to be a syndication.
You have to examine the level of participation with all of your non-accredited investors, right? And so the way we get around that, not get around, but the way that we address that is by assigning responsibilities to the people that are participating in your joint venture. And so let's say there's 10 of you and everyone's bringing 5 to 10 grand a pop, right? Well, there are activities that have to take place with any company, right? You're dealing with taxes, you're dealing with operations, you're dealing with communication, you're dealing with whatever, you know,
right,
other professionals. You take all those activities and divvy it up so people are participating to some degree. I think it'd be tough to do with 35 people. I don't know if there's that many activities out there, but
so I guess my vision or thought on this was, if let's say I set up the fund, and then like in that operating agreement for that LLC, or maybe it's not technically a fund, maybe it's just an LLC, like I have the overall decision-making authority or whatever. And so then I am active in the project, if it, you know, and then like if I just have one other partner, it's me and that partner as the, let's call it, you know, two general partners. So I'm acting on behalf of all the members within that, I guess, fund. Does that not count? I feel like I'm making this too complicated, but
No, I mean, I understand what you're saying. I think
okay.
you'd have to go back to, again, just a level of participation. It's every member would have to actively participate in some way. So you wouldn't be able to perform all of the activities for all of those investors and then get around having you basically used to have a security, right?
Okay. So it just, if, as long as it says syndication and then I follow the syndication rules, then that would work.
Correct.
Okay. I think that clarifies it. Thanks, guys.
Awesome. I saw a question as well from Bob Boren. Hey, Bob. General education on setting up InvestNext platform to legally raise capital. I think our support team can certainly help you out there to make sure that we're, you know, staying in line with your operating agreement. So reach out to us, support@investnext.com, if you have any questions or any concerns that you're coming up with in setting up the investor portal. A lot of questions about setting up entities for businesses. I know you guys perform some of those services during the process of setting up a new deal. I don't know if you want to quickly hit on that.
I'd like to address that, Evan, because we get a lot of this, and there's really kind of two different ways to approach setting up an entity. Right now, you know, the real popular thing is to jump on a LegalZoom and download their form operating agreement that's 2 pages long, right? And that's just in the interest of getting set up so you can get moving and shaking and raising money or whatever you want to do. I would tell you in this space, there are some pretty important decisions to make before you jump the gun and do that. One is tax treatment. And so when you take a look at an LLC, there is no IRS classification for an LLC. There is no, so the way that they treat that is you have a default classification. So if you're a single member LLC, the default is it's a disregarded entity. So it just goes on your personal return. If you are a multi-member LLC, it becomes the default is partnership. But what you want to take a look at is getting out ahead of what you're doing just in the spur of the moment and really figure out, okay, if I'm going to do this, what does this look like? I'm going to probably have an operating company, and then I'm going to have maybe a holding company that holds the interests, whether I'm the syndicator or whether I'm the passive investor. So you want to take a look at, maybe there's a subchapter S election you want to take because it makes sense. There's tax benefits to doing that. The other thing is on the syndication side of the house, you want to take a look at where your money's coming from, right? And so like our default special purpose entity is an LLC because it's flexible, lets you do the non-pro rata distributions and allocations. But a lot of countries don't recognize LLCs either. They haven't figured out how it works. So their default is to tax it as a corporation. So if you have investors from the UK, from Canada, I think Israel, Megan, was that one of them? Israel. If you have foreign investors that are coming in and you set up your structure as an LLC, that may concern them because they're being taxed twice, right? And so there we would take a look at setting up a limited partnership instead. And so, you know, the money and time you save on the front end of using a LegalZoom to set up an entity, you're going to have to potentially redo it anyway, because at some point you're probably growing into a larger business structure than just that one-off transaction. The other piece that's important is the jurisdiction, right? So I'm sure that everybody here has heard about a Wyoming LLC and a Delaware and a Nevada, and there's pros and cons to each. So the other thing you have to consider is, so cost is important. Depending on the jurisdiction, you may have some prohibitive cost every year. Like California is terrible. I think it's $850 or something to set up, and $850 a year. And, you know, if you're not doing a ton of business in California, it may not make sense to do that. There's other states that are cheap. They're cheap to renew. They're easier to work with. So you want to take a look at that in terms of jurisdiction. And you want to take a look at what is the potential remedy for a potential claimant. And so this is where things change from state to state. So for example, Wyoming, we like Wyoming because Wyoming has what's called a charging order statute. So the only remedy for potential claimant is to get after mandatory distributions of income from that company to whoever that defendant is. So if we have a company, Byron, Megan, Evan, and Kevin have a company, and we're all equal members, and Kevin somebody files a lawsuit against him, right? And whatever insurance he has doesn't cover the extent of lawsuit, so they take him to court, they get a charging order. All that they can do is get to Kevin's mandatory distributions from the company. In other jurisdictions, the court will allow them to step into the shoes of the entity and sell off assets to satisfy a judgment. So some of these decisions are a lot more important than just, can I do it in 10 minutes for $30 on a legal Zoom? There's some significance there.
David, go
So
ahead.
I think, oh, go ahead.
Well, real quickly, I'm joining via Zoom, not LinkedIn, so I don't think I'm seeing the questions, but I have a couple. First of all, for Andrea's question about the friends and family, what about crowdfunding or interstate options? And then the second one is what services does Three Pillars provide to investors, operators, syndicators, and who do I contact with you?
I love that second question. Byron loves talking about that. I'll answer the first question. I'll let Byron take the second one. For intrastate offerings, they're just really limited because you can only, just like the name implies, you can only take investors that are in the state of your principal place of business. And you have to be really, really careful because you have to do a detailed analysis about where someone lives, right? Because some people might have residence in multiple states, or they might have an LLC that they formed in Wyoming, but they actually live in Colorado. And if you violate that provision of only selling to in-state investors, then you basically lose your exemption from registration, which is bad. That's what you don't want to happen. So intrastate offerings are great. If you're doing kind of a small offering and it's limited in geographic scope as to where your investors are. But we don't see too many of those with our, increasingly digital world. Investors tend to be kind of all over the place. Crowdfunding is interesting. It's hasn't gotten as much use as the SEC thought it would since its inception with the Jobs Act. They've recently relaxed some of the rules around crowdfunding to try to get more people using it. But I do think it's an interesting way to raise money if you do want to raise in those smaller increments and not have to worry about if someone's accredited or non-accredited. But there's just regulations involved in that. You have to find an a crowdfunding platform. The platform always takes a certain percentage of money raised, things like that. So it's definitely an option to explore for Andrea if that's what she's trying to do. But it comes with its own set of rules and regulations as well.
Maybe adding to that, any consideration to like Reg A, which is you could theoretically also raise from non-accredited investors, smaller dollar amounts, doesn't have the ties that you would with Reg CF or crowdfunding.
Yeah, Reg A comes with a host of regulations. It's meant to be a testing the waters offering for people that want to try an IPO. The problem with Reg A, I mean, it sounds great when you say it that way, that you can take accredited or non-accredited investors, it doesn't matter. But there's a ton of disclosures that have to be made. Some of those are on an ongoing basis, even after the offering is launched and done. So it just tends to be much too burdensome for an early syndicator. It's really for somebody who's built a company with like a nationwide presence and they're thinking about taking the company public.
Thank you.
Thanks for the question, David and Kevin.
Good job, Megan. I was fielded that nicely.
Thanks, Byron.
In terms of, you get your 2 demerits back. Oh, those are my demerits. My apologies. Okay, so what do we provide? What services do we provide? Our bread and butter, our sweet spot is exactly what we've described here: 506B, 506C offerings, and really advising clients, particularly people that are newer to this, right? One of our big things, and we've talked about this with Evan and the team and Kevin, and like, we like to remove these barriers where we can, and if we can do that through cost structure, we certainly try to do that. And then just in terms of how intentional we are working with new clients. And so you'll see, we spend a lot of time with clients walking them through how to develop, your structure on your offering, and how to review your financial model. And let's incentivize investors to come in where it makes sense. Talking through your waterfall, right? What fees what's customary for you to take in the type of deal that you're doing? So if you're doing like a big development deal, and there's a big project management component, those fees are probably customary and would be expected. And then at some point your project's developed and now you're leasing up and stabilizing. Well, that fee structure goes away and now you're doing property management, right? And so we try to make it as neat and clean from an investor's perspective on the fee structure. And then, what levers are we pulling otherwise to make sure that, the way your offering is set up is aligned with performance and what the investor would expect. So the offering side of the house, that's probably, again, I would say typically 80-90% of our work. We do offer on the real estate side of the house some transactional support. So we're talking due diligence, title work, survey. It's not my favorite, to be honest with you. And that's just this week because I'm dealing with 2 large closings, and it takes a lot of time and it's very detail oriented. But in some jurisdictions like Colorado, real estate agents can quasi practice law. And so an agent on the commercial and the residential side of the house can walk you through the closing process. They write the contracts, they get you to closing, and they're kind of, shepherding that process along. In other jurisdictions, you have to have an attorney write your PSA and do all of that transactional stuff, review loan documents and set up special purpose entities. And it gets very involved. And so we can do that stuff. We have the skill set to do it, but those are really the 2 things that we do. And then there's always contract related stuff. So developing the relationships between co-GPs, writing that joint venture agreement that Megan described. We do that kind of stuff. That's routine. That's secondhand for us. And then, everyone, obviously you want to know about fee structure, right? So just look on our website. We're very transparent about our fee structure. And again, being cognizant of people that are just getting into this space. If we have people that are coming over from InvestNext and using the platform, we'll give you a discount. So we'll give you a 10% discount off our fee structure. So, it's not a ton, but it's a good start. It's a weekend in Blackhawk or Cripple Creek or something. So
awesome. Well, I want to be mindful of time. We've got a couple minutes left. Thank you both so much for hosting this meetup with us. Thank you everyone so much for attending. We'll kind of end it at, how can people get a hold of you if they need a syndication attorney? And is it best to go through the website, email? What's your process there?
Yeah, our website is great. I mean, there's a form there. And then, email is wonderful because when we're drafting, like, we go into the salt mines, right? It's for 3 or 4 hours at a time. And so we'll definitely get back to you. But if you want email addresses, it's simple. Mine is Byron, BYRON at the number 3pillarslaw.com. Megan's is the same. Megan at 3pillarslaw.com. And yeah, I think we're pretty darn responsive unless we're in the salt mines drafting documents.
I know personally you've never been in the salt mines. When I email you guys, it seems like you respond real quickly. So appreciate your guys' time. Thank you so much. We can share out that presentation as well after the call, if that's okay with you.
Absolutely.
Sure.
Awesome. Well, thank you everyone for attending. We'll see you again very soon.
Thanks, everyone.
Thank you, guys.
Thanks,
Nice to meet
everybody.
everyone.